A quiet announcement from Beijing that barely made headlines. The People's Bank of China resumed something they'd paused for 6 months. Something that sounds mundane on paper but represents one of the most significant monetary moves in decades. For 13 consecutive months, through December 2025, China has been systematically purchasing gold, not just small amounts. We're talking about adding to the 2,300 tons they officially hold, making them one of the largest sovereign gold holders on Earth. But here's what should grab your attention. This isn't happening in isolation. At the exact same time, China has quietly reduced their U.S. Treasury holdings by over $300 billion since 2013. That's a 40% reduction from their peak position. And by the end of this video, you'll understand exactly what this pattern means, why it's happened before in history with devastating consequences, and what it signals about the global financial system right now. Let's break it down. Before we dive into what China's doing, you need to understand the pattern. Because once you see it, you'll realize we've been here before, multiple times throughout history. Think of it like a 3-stage cycle that repeats across centuries. Stage 1 is dominance. One nation becomes the center of global finance. Their currency is what everyone wants. Trade flows through their banks. Capital pours in from everywhere seeking returns. Asset prices boom. Confidence reaches extreme levels. This was Amsterdam in the 1600s, London in the 1800s, New York in the 1900s. Every single time the setup looks identical. A nation rises to become the undisputed economic powerhouse. Their banks become the clearinghouses for international trade. Their currency becomes the medium everyone holds in reserve. Foreign investors pour money into their markets, seeking returns. Real estate prices surge. Stock markets climb higher and higher. Everyone wants a piece of the action. The newspapers print stories about endless prosperity. Economists declare that old economic rules no longer apply. This time is different, they say. The boom will last forever. Stage 2 is overextension. Success breeds confidence. Confidence breeds spending. The dominant power starts living beyond its means. Government debt expands. Wars are fought. Programs are launched. All funded with borrowed money. But nobody worries because asset prices keep rising. Money printing accelerates to keep the party going. Debt grows faster than the economy can support it. Here's the thing about stage 2. It doesn't happen overnight. It's gradual. It's like slowly heating water in a pot. The temperature rises degree by degree, but you don't notice until suddenly you realize the water is boiling. The government starts with small deficits. Just temporary spending, they say. Just to fund this one war. Just to launch this one program. Just to stimulate the economy during this one downturn. But the temporary spending becomes permanent. The deficits grow larger. The debt accumulates year after year. And because the country is the global financial center, borrowing is easy. Foreign governments buy the bonds. Foreign banks finance the spending. Everyone wants to hold the dominant currency, so there's always demand for the debt. Interest rates stay low despite rising borrowing. Asset prices continue climbing. Real estate becomes unaffordable for average citizens. But prices keep rising anyway. Stock valuations reach levels that seem absurd by historical standards. But nobody questions it because prices keep climbing. Wealth inequality expands as those who own assets get richer while those who work for wages fall behind. But the economic data looks good on paper. GDP is growing. Unemployment is low. The stock market hits new records. Everything seems fine on the surface. Stage 3 is the rotation. This is where it gets interesting. Smart money sees the mathematical reality. Not the public, not politicians, just the institutions that actually read balance sheets. They start moving quietly. Major holders reduce positions. Foreign investors diversify away. Wealthy entities shift capital internationally. No press releases, no announcements, just systematic, calculated repositioning. This phase typically lasts 18 to 36 months. That's the window where repositioning happens, before markets adjust violently. Let me explain what happens in stage 3 in detail, because this is where we are right now. The smart money, and by that I mean the institutions with access to real data, the sovereign wealth funds, the multi-generational family offices, the central banks with inside information, they start seeing cracks in the foundation. They look at the debt numbers and realize the mathematics simply don't work anymore. They see government deficits that are structurally impossible to close without either massive spending cuts or massive tax increases, neither of which are politically feasible. They see interest payments on government debt growing faster than tax revenue. They see money supply expansion accelerating. They see the gap between asset prices and underlying economic fundamentals growing wider and wider. And they make a decision. They start reducing exposure. Not dramatically, not all at once. Gradually, systematically. They sell small positions. They let bonds mature without reinvesting. They shift new capital allocations away from the dominant currency and into alternatives. They diversify into other currencies, into hard assets, into jurisdictions with better fiscal discipline. And they do this quietly because announcing it would cause the very panic they're trying to avoid. There are no headlines, no press conferences, no announcements. Just quiet, calculated repositioning happening behind the scenes in boardrooms and treasury departments around the world. Now, let me show you 3 times this exact pattern played out. Same stages, same sequence, same result. Picture Spanish galleons returning from the Americas, loaded with gold and silver in the 1500s. The Spanish real was the global currency. Madrid was the financial center of Europe. Spain controlled half of Europe through the Habsburg dynasty. Spanish armies were the most powerful military force on the continent. The Spanish Armada ruled the seas. Trade routes from the Americas, from Asia, from Africa, all flowed through Spanish ports. The wealth flowing into Spain seemed infinite. Silver mines in Potosi produced more precious metals than Europe had ever seen. Gold from Mexico, Peru, and Colombia filled Spanish treasuries. The Spanish real became the currency everyone wanted to hold. If you were a merchant in Amsterdam, you kept your accounts in reals. If you were a banker in Florence, you settled international transactions in reals. Spain was the undisputed financial superpower of its age. Then came the spending, wars with everyone, France, England, the Ottomans, the Dutch, a massive military spanning 3 continents, royal palaces that cost fortunes, the Spanish Inquisition burning money along with heretics. King Philip II was fighting simultaneous wars across Europe while maintaining a colonial empire stretching from the Philippines to Peru. The cost was astronomical. By 1550, government spending hit 300% of tax revenue. Let me repeat that. 3 times what they collected in taxes. The difference was borrowed from Italian banks and German merchants. The Fugger family of Augsburg became Spain's primary creditors. Genoese bankers financed the war machine. Anyone who would lend money found a willing borrower in the Spanish crown. But gold kept flowing from the New World, so nobody worried. As long as the treasure ships kept arriving, Spain could keep borrowing. Asset prices in Spain kept rising. Property values in Madrid soared. Everyone felt rich. The Spanish court was the most lavish in Europe. Nobles lived in spectacular luxury. The party continued year after year. Stage 2, check. Here's what most history books skip. The part that actually matters. 1555, the Fugger family. Spain's biggest creditors. Banking dynasty controlling half of Europe's capital. They started demanding repayment in physical gold, not promises, not IOUs. Gold. They wanted out now. Why? Because they could read balance sheets. And the balance sheets said Spain was functionally bankrupt. The numbers simply didn't add up. Government revenue couldn't cover interest payments, let alone principal repayment. The only thing keeping the system functioning was the continuous flow of new silver from the Americas. But the Fuggers understood something critical. This couldn't last forever. Mine production would eventually decline. Spain's wars would eventually drain even the massive American silver reserves. The mathematics were clear. Spain was borrowing at interest rates that made repayment mathematically impossible. At the same time, wealthy Spanish merchants began transferring operations to Amsterdam, not all at once. Gradually, opening offices, moving inventory, redirecting trade routes. The smart money was leaving quietly. Ships that used to unload in Seville started unloading in Amsterdam. Trade networks that had been centered in Spain started shifting north. Capital that had flowed into Spanish ventures started seeking opportunities in the Dutch Republic. Here's the kicker. The Spanish government was paying 40% interest on some loans. 40%. Let me repeat that. 40% interest. That's not a sign of strength. That's desperation bleeding through official documents. That's a government that knows it's broke, trying to convince everyone else it's fine. When you're paying 40% interest, you're not borrowing because you're confident about the future. You're borrowing because you're desperate, and lenders know you're desperate. The risk premium is astronomical because the probability of default is astronomical. But the Spanish government kept borrowing anyway because they had no choice. The alternative was to admit the empire was bankrupt, which was politically unthinkable. Stage 3, verified. 1557, Spain defaulted on its debts. First time. Credit markets froze overnight. Spanish bonds became worthless paper. The government literally seized private gold shipments arriving from the Americas to pay soldiers. Absolute chaos. Merchants who had extended credit to the crown lost fortunes. Banks that held Spanish debt faced insolvency. The financial system that had been built around Spanish creditworthiness collapsed in weeks. But the king promised it was just temporary, a one-time problem. Everything would be fine. Trust the system. The crown just needed time to reorganize its finances. Revenue from the Americas would increase. New taxes would be implemented. This was just a momentary disruption. Have faith. But then 1560 came. Spain defaulted again. And 1575. Again. 1596. Again. 1597. Again. 4 defaults in 40 years. Each time the government promised it would be the last. Each time they claimed the economic situation was improving. Each time they insisted the empire was fundamentally sound. And each time, more creditors got destroyed. The currency collapsed. Inflation destroyed the middle class. Spanish power evaporated like morning fog. By 1600, the Golden Age was over forever. Spain never recovered its position as the global financial center. The country that had dominated European finance for a century became an economic backwater. The Spanish real was no longer the currency of international trade. Capital had fled to more stable jurisdictions. Spain's century was over. Stage 4 complete. But here's the detail that matters for today. The one everyone misses. Where did all that money go? Where did the Fugger family move their capital? Where did the merchants relocate? North to Amsterdam, to the Dutch Republic? The center of global finance shifted. And what happened next makes Spain's collapse look like a practice run. The Dutch East India Company was worth approximately $28 trillion in today's money. Let me put that in perspective. That's more than Apple, Microsoft, Google, and Amazon combined, times 2. One company, worth more than the 4 biggest tech companies today, combined, doubled. The scale of Dutch financial power in the 1600s is almost incomprehensible by modern standards. The guilder was the global reserve currency. Ever wondered how a small country like the Netherlands once dominated the world? A big part of the answer lies right here in Amsterdam. This city wasn't just about tulips and canals. It was the world's first global financial hub. The Amsterdam Stock Exchange, the very first of its kind, was the engine of a global empire. If you were a merchant back then, from any corner of the globe, and you had a big idea, this is where you came. Need to finance a risky voyage to Asia for spices? Go to Amsterdam. Want to start a massive plantation in the Americas? Go to Amsterdam. Required capital for mining in Africa? You guessed it, go to Amsterdam. The Dutch didn't just build canals, they built the modern financial world. Instruments we take for granted today, like letters of credit, insurance contracts, and even futures markets, were all pioneered in the bustling offices of this incredible city. Thanks for watching, and don't forget to subscribe for more amazing history. Then came the wars, always the wars. 3 separate conflicts with England between 1652 and 1674. Wars with France, wars with Spain. The Dutch military presence stretched from Indonesia to Brazil to South Africa. A global empire requiring a global military. And it all cost money, mountains of money. Government debt went from 4 million guilders in 1650 to 80 million by 1690. 20-fold increase in 40 years. To pay for it, they printed money. Sound familiar yet? The States General borrowed aggressively from Dutch banks and wealthy merchants. Interest rates on government debt started rising as lenders recognized the increasing risk. But the government kept borrowing because the wars had to be funded. The East India Company had to be protected. The colonial territories had to be defended. There was no choice but to borrow. Meanwhile, asset prices in Amsterdam went absolutely insane. Tulip mania hit in the 1630s. Tulip bulbs selling for more than houses. Single rare bulbs costing 10 times an artisan's annual income. Asset prices completely detached from any economic reality. Everyone getting rich on paper. Everyone convinced the good times would last forever. This is the classic sign of stage 2. When asset valuations become completely divorced from fundamental economic value, when people are buying things not because they produce income, but because they expect to sell them to someone else at a higher price, when speculation replaces investment as the primary driver of market prices, you're in stage 2. Stage 2, complete. Here's what should terrify you about the Dutch situation. The Bank of Amsterdam, supposedly the safest, most trusted institution in Europe. They were secretly lending out depositor money to fund government wars. Classic fraud, using new deposits to pay old withdrawals. Fractional reserve banking before it had a name. The bank was supposed to maintain 100% reserves backing all deposits. That was the whole basis of trust. Merchants kept money at the Bank of Amsterdam because they believed every guilder on deposit was backed by a guilder in the vault. That guarantee was the foundation of Amsterdam's financial credibility. But starting in 1672, the bank began secretly lending reserves to the government to fund wars with France and England. The directors of the bank made loans that violated their charter, that violated the trust of depositors, that put the entire financial system at risk. And they did it in secret. Depositors had no idea their money was being used to finance military operations. Merchants had no idea the bank was insolvent. The fraud continued for over a century. For over 100 years, the Bank of Amsterdam operated while technically bankrupt, keeping up appearances while the underlying reality was fundamentally unsound. 1690. Smart money started moving. Major banking families quietly transferred operations to London. Portuguese traders who'd made Amsterdam wealthy began relocating. German financiers pulled capital out systematically over years. No announcements, no headlines, just quiet, calculated exits. Why? Because insiders knew something the public didn't. The Bank of Amsterdam was broke, had been since 1672. They'd been running a fraud for decades, but the secret was kept until it wasn't. If you were a Rothschild or a Baring, if you were running a major trading house or banking operation, you had access to information the general public didn't have. You could see that Dutch government finances were deteriorating. You could see that the Bank of Amsterdam's balance sheet didn't add up. You could see capital flows shifting away from Amsterdam and toward London. And you made the rational decision. You started moving, not all at once. Gradually, you opened an office in London. You started conducting more business there. You shifted more capital into British bonds and less into Dutch bonds. You hedged your exposure. And you did it quietly because if everyone knew what you were doing, it would trigger the very panic you were trying to avoid. Stage 3, verified. Now here's the part that should absolutely terrify you about what's happening today. The Dutch government kept reassuring everyone, everything's fine. The bank is solid. The guilder is strong. The economy is recovering. Trust the system. Don't panic. We've got this under control. They said this while the bank was literally insolvent. 1795, French Revolutionary armies invaded. The Dutch Republic fell. The guilder collapsed overnight. The Bank of Amsterdam's decades-long fraud was exposed. Depositors who trusted the system lost everything. Riots in the streets, political chaos, fortunes evaporated, 150 years of dominance, gone in months. The transition from stage 3 to stage 4 can happen faster than anyone expects. One day, the system seems stable. Banks are functioning, currency is accepted, trade continues. The next day, armies are marching, banks are failing, currency is worthless. The speed of the collapse always surprises people because they don't understand that the collapse is sudden. It's the culmination of decades of accumulated problems. The system was rotten from within. The facades were maintained through fraud and money printing. And when the facade finally cracked, everything fell apart at once. Stage 4, complete. And where did the capital go this time? Across the channel to London. Britain was next in line. But Britain's collapse is the one that should keep you up at night because the setup is almost identical to America today. Same debt levels, same overextension, same denial, same pattern. Britain controlled 23% of the world's population at its peak, a quarter of Earth's entire landmass. The pound was the global reserve currency for over 200 years, longer than any currency in modern history. The City of London financed everything. Railroads across America, mines in Africa, plantations in Asia, infrastructure on every continent. Over 60% of all international trade settled in pounds. The gold standard was built around sterling. British naval power was unmatched. The Royal Navy ruled the seas. British India alone contained 300 million people. British colonies circled the globe. The sun literally never set on the British flag. British power seemed infinite, eternal, unshakable. If you were a merchant in Buenos Aires, you invoiced in pounds. If you were a banker in Singapore, you held reserves in pounds. If you were a government in Cairo, you borrowed in pounds. The pound sterling was the currency of global commerce. British banks were the intermediaries for international trade. British insurance companies covered global shipping. British financial institutions were the most sophisticated in the world. Stage 1, absolute and undeniable. 1949. The exodus began. Major British corporations started moving operations to America. Unilever, Shell, British Petroleum, not shutting down in Britain, just shifting investment, redirecting capital, building elsewhere. If you were running a major British corporation in 1949, you looked at the situation and saw what was coming. Taxes in Britain were confiscatory. The Labour government had nationalized major industries. Economic growth was anemic. The population was exhausted and demoralized. Meanwhile, America was booming. The American economy was growing rapidly. American markets were enormous. American taxes were lower. American regulations were lighter. The choice was obvious. You kept your British operations running, but you shifted new investment to America. You built your new factories in America. You hired your new workers in America. You directed your R&D spending to America. Gradually, systematically, you reduced your exposure to declining Britain and increased your exposure to rising America. The brain drain accelerated. Scientists, engineers, entrepreneurs, academics, all leaving for opportunities abroad. Britain offered high taxes and declining prospects. America offered growth and opportunity. The choice was obvious. If you were a talented scientist or engineer in Britain in the 1950s, you had options. You could stay in Britain with its high taxes, rationing, and limited opportunities. Or you could move to America, where wages were higher, opportunities were greater, and the economy was booming. Thousands made the rational choice. They left. Britain lost an entire generation of talent. The people who should have been building the next generation of British industry, who should have been creating the next generation of British technology, who should have been leading the next generation of British innovation, they all moved to America. By 1960, foreign investment in Britain had fallen 62% from pre-war levels. Think about that. 62% decline. The money was leaving, the talent was leaving, the future was leaving. But the government kept saying everything was fine. 1967, The pound devalued 14.3%. Overnight, you go to bed one night, wake up the next morning, your currency is worth 14% less, just like that. No warning, no vote, just gone. The government had no choice. They'd run out of foreign currency reserves trying to defend the exchange rate. The game was over. People who had trusted the government, who had believed the official statements, who had kept their savings in pounds, lost 14% of their wealth overnight. Not through taxation, not through spending, just through currency devaluation. The government simply declared that the currency was worth less, and it was. 1976, Britain went to the International Monetary Fund for a bailout, the empire on which the sun never set. The former global superpower begging for emergency loans like a developing nation. The humiliation was complete. The IMF imposed conditions, spending cuts, tax increases, monetary discipline. Britain, which had dictated terms to the world for 2 centuries, was now taking orders from international bureaucrats. The pound lost reserve currency status. International trade shifted to dollars. Britain's century of financial dominance ended forever. It never came back. Now, here's where it gets really interesting. Stage 3, the trigger. The warning sign that everyone's missing. Here's what mainstream media isn't telling you. The smoking gun evidence that's hiding in plain sight. China held over $1 trillion in U.S. treasuries back in 2013. Today, $760 billion. They've sold over $300 billion. This isn't speculation. This is documented public record from the U.S. Treasury International Capital System. You can verify this yourself. The data is published monthly. Anyone can access it. China is systematically, deliberately reducing its holdings of U.S. government debt. But they're not just selling dollars. They're buying something very specific. Gold. November 2024, China resumed gold purchases after a 6-month pause. Why did they pause? Probably because gold prices spiked too high. They waited for a pullback, then resumed buying. That's strategic accumulation. That's not panic buying. That's patient, calculated positioning. 13 consecutive months of purchases from November 2024 through December 2025, continuously, systematically, relentlessly. Their officially reported gold reserves now stand at 2,300 tons, according to the People's Bank of China. Let me read you something. This is a direct quote from Chen Weidong, director of the Research Institute of Bank of China, published statement on the record. Quote, China must build a multi-layered systematic strategy to guard against mounting risks tied to U.S. sovereign debt and the dollar-based financial system. China has cut its U.S. Treasury holdings by over 40% since 2013. End quote. That's not me saying it. That's not some conspiracy theorist on the internet. That's a Chinese banking official published in China Daily, July 2025. He continues, quote, key priorities include gradually reducing U.S. Treasury holdings, increasing non-dollar investments, and advancing renminbi internationalization, end quote. Translation, they're executing stage 3 deliberately, systematically, with a timeline, with a plan. This isn't accidental. This isn't random. This is official Chinese government policy to reduce exposure to dollar-denominated assets and diversify into alternatives. The global financial system is entering a major historical transition as China and many central banks quietly reduce their exposure to the U.S. dollar and move toward gold and real assets. According to the World Gold Council, central banks purchased more than 1,000 tons of gold in 2024 for the 3rd year in a row, and 95% expect their gold reserves to continue rising. China alone has sold over $300 billion in U.S. treasuries and significantly lowered the dollar's share in its reserves. History shows that every reserve currency follows the same cycle: rapid growth, rising debt, capital flight, and eventual loss of dominance. And the United States is now in the stage where large institutions are repositioning quietly. Military strength and money printing have never stopped this process. And today, BRICS nations and emerging economies are building systems to trade outside the dollar. While the shift may seem slow, once it reaches its final phase, it happens quickly, making gold, commodities, and real assets increasingly important for protecting wealth during this global transition. Thanks for watching. See you in next video.